Today I'm going to just briefly speak about the peer-to-peer sharing economy and the two investments we have with GSV Capital, one Lyft and the other one Rover, both of which are investments we did a couple years ago between 2013 and 2014. To start with Lyft, it accounts for 5.8% of the portfolio as of March 31st. When we first made the investment in early 2014, Uber was raising $1 billion. They were about 9 times bigger than Lyft. They were growing very quickly and expanding globally. And so it was a really difficult decision on many ways to invest in Lyft. And the two key reasons why we decided to do that was, one, an exceptional management team, which we felt was capable to really differentiate the Lyft brand away from Uber. And two, also that focus on the culture and the brand itself, which was very kind of impressive in the beginning, because Uber was more that brand of having your personal driver, kind of the traditional cab service. But Lyft had a very big emphasis on being cool, being fresh, really targeting towards the millennial generation. And so that continues to be one key differentiator today, even more so as we're seeing all the mishaps that have happened with Uber over the last 12 months. So going forward, we think that is going to be a key fundamental that Lyft will continue to create value from. Going back to just today, and in terms of new signups, just over the last 6 months, if you look at the split between millennials, on Lyft, actually 78% of new signups have been millennials, aged 34 and younger. On Uber, it's about 64%, and then adversely, 22% are 35% or older on Lyft, and Uber has 36% of new signups in that age group. Also looking at the kind of the quality of the service and as it relates to working with the drivers, SharesPost, which is one of our investment portfolio companies, they did a big research report on the ride-sharing economy last year, which was published in December. And some of the data that they showed was the driver satisfaction rate on Lyft is significantly higher than that of Uber, 76% versus 49%. And also the brand awareness, which obviously Lyft is still in an earlier stage and smaller, is increasing from 20% in 2016 to 29% in 2017. Meanwhile, that of Uber is decreasing, which is a little bit coupled to all the issues that they had in 2017. And also most recently, Lyft announced that they're going to be investing about $100 million in their drivers in different ways. So clearly that's another differentiator that we're seeing that trend happening where drivers are much more likely to operate on Lyft. The company itself announced those figures earlier this year. We're seeing very strong growth on both passengers and drivers. So passengers grew nearly 100% to 23 million at the end of 2017. Drivers grew 100% to 1.4 million at the end of last year. Also, if you look at just the number of completed rides, when we first made our investment in early 2014, they had just crossed 3 million completed rides. This has grown over 100 times in the last 5 years, now to over 376 million rides, and continues to be on a very strong trajectory. This year so far, the company has continued to basically take that momentum from last year and continue it in 2018. And what we've seen just over the last couple of years as a result of kind of the focus, the execution, the quality of management, the focus on the brand, kind of the differentiation of who they are versus Uber, the market share has continuously grown. So when we started, Uber was about 9 times bigger than Lyft in the US. Last year, Lyft mentioned multiple times in the media that they're about a third the market share in the US. And actually, more recently, they mentioned that in some core markets, they're already at 50% or higher. So we expect that by the end of this year, there will be somewhere around 45% market share in the US. Just looking at comparing the two growth rates and how Lyft is currently growing and how Uber's business in the US is growing just for ride sharing. We anticipate that over the next 18 months, 18 to 24 months, Lyft will be on par with Uber just in general in the US, and obviously growing at a faster rate. If they maintain that, they will ultimately be probably bigger. I think the one thing that is going to be becoming more and more important is just looking out the next 3 to 5 years. Autonomous driving has obviously been a big focus point over the last couple of years. There's been a lot of investments flowing into that kind of space. So just looking at how Lyft compares to Uber today, one, they have a number of partnerships. On the software side, it's with Nutonomy, with Waymo, Drive AI, and then on the hardware side, with GM, Ford, Aptiv, and Jaguar. And I think what's really key here is that the relationship and the partnership with Waymo, which arguably is the most advanced and kind of best placed technology on self-driving, that will be a big differentiator for Lyft going forward. Waymo is also an investor, as is Google, and Waymo is Google's self-driving arm. Uber, meanwhile, has 2 partnerships, one with Daimler and one with Volvo, so obviously they're also very focused on that. Switching gears to Rover, which is today 1.5% of our portfolio. Just as some background, we invested in Dog.Vacay, which was one of the 2 competing companies. Basically, early last year, Rover acquired Dog.Vacay, so we became a shareholder of Rover. And essentially, they're enjoying kind of a big leadership position in the market as it relates to dog boarding and dog services overall. Just as at a glance today, the different services that Rover provides. One, the boarding business, which is the core business they started with originally, where you leave your dog with somebody for 1 or 2 or 3 nights. The other new businesses today include house sitting, where somebody comes to your house basically and takes care of the dog. There's daycare, where you can drop off your dog for a couple of hours, and typically that host has many different dogs from different users. And then the new service that's growing the fastest, and it's really becoming a core focus, is on-demand walking. It is on-demand, similar to Lyft and Uber, where you need somebody to walk your dog in the next hour. You go on Rover, and basically you get matched with somebody to provide that service. This is obviously a service that WAG recently raised $300 million for from SoftBank, and it's clearly becoming a very attractive area just in terms of traction and value creation. So Rover is highly focused on that service going forward. The underlying trend or theme that basically supports Rover and everything that's happening in that space is what we call pets are people. Essentially, pets are nowadays part of the family. They're treated like a child. So what's really core for a business to succeed in this industry is going to be quality. And so looking at the different quality measures on Rover, it's important to note that one, their net promoter score is in the high 70s, which is very good for a technology company. Basically the 5-star rating, so 95% of service providers get a 5-star rating, which is also very positive. You look at the iOS rating, it's at 4.9 star, and Glassdoor, which measures kind of the internal company kind of effectiveness and rating, is at 4.1, which is also very good. So again, this is core for the company to be successful, is really keeping very high standards in quality going forward. Some recent data points, they just announced last week they raised $155 million from a group of investors, including T. Rowe Price, Winslow Capital, Cross Creek, TCV, Greenspring, and Spark Capital. They also announced that net revenue last year grew well over 100%, and they also announced that currently they're processing about 1 million bookings per month. The company continues to be on a very fast growth, and going forward, I think that will, there's strong visibility that this will continue for multiple reasons, which I'm going to touch on. But just quickly on the usage from the demand side, what we've seen over the last couple of years is that each and every new cohort uses the platform more often. So for example, the 2017 cohort has used Rover 6 times in the first 12 months, which is better than the previous year, which was better than the previous year, and so forth. And what we're seeing in 2018 so far is, again, that the newest cohort is outperforming the old one again. Then looking at the supply side on the seeders, nearly half of them are acquired by word of mouth. The rest is through marketing. The one thing that is core to maintaining a very high quality of seeders is one, the acceptance rate, which is currently at about 15%, but two, also the filtering of kind of not the great seeders, but kind of mediocre and bad actors. So the company consistently has thresholds that somebody has to meet in order to be a seeder to be a host provider on the platform. And the one question we get quite consistently is about bad actors, people who try to go around the system where they do one transaction with somebody once and then basically go directly with that person. Well, there is two real issues with that. One is there is no insurance policy involved anymore, so that's an issue for the user. But two, for the host himself or herself, once Rover has been quite effective in identifying those people that go around the system, and once they see that you are likely to be doing that, they basically exclude you from ever being on the platform again, which means there is no more future potential for basically getting value out of the platform. So that's a big incentive for somebody to stay, to be transacting through the platform. Just in terms of the growth, today there are 200,000 seeders on Rover. This is up from about 100,000 a year ago. And just looking forward at the potential, on one hand, pet boarding today is only used about 8% of the times. The rest is really friends and family. So one, there's going to be the potential of the market expansion itself. But number two, Rover today is actually just capturing less than 4% of the existing market. And by the way, the rest is very fragmented, so they are the clear leader. But if you just look at some other comparable marketplaces in the peer-to-peer sharing economy that are at a little later stage, for example, Airbnb captures just over 10% today. Lyft and Uber capture over 20% today. So Rover is still in the very early stage. So while they get the market expansion benefit, they also have a lot of market to capture within the existing market itself. And then two other kind of important things. Pets growth in the US is currently outpacing population growth, which is a trend that will probably maintain for the foreseeable future. And also Americans on average travel 27 nights per year currently, and that's another trend that consistently increases, both of them basically fueling the need for services like Rover. This is just a quick overview again for what I just said. Pets in the US, in US households, compared to 30 years ago, it's jumped from 21% to 68%. And also another key characteristic is pet owners in the US are much more likely to spend today on their pets. 70% do so. Just in terms of predictability, one, as I said, the market expansion and the market growth is one, but they're also now with the most recent financing expanding internationally. They will be in Europe later this summer, and in the next couple of years they're expecting to be in 14 plus countries. And so what we believe Rover will be benefiting from is being the leader in its category. It will get disproportionate gains, similar to what we've seen with Airbnb and with other businesses. So with that, I thank you. Thanks.